My name is Max Gagliardi, and you're listening to the Talk Energy Podcast. If you're watching this video, take a moment, hit the subscribe button on YouTube, or you can follow us on your favorite podcast app. You could leave a review. That would help the channel. Also, check out our energy company's weekly newsletter. That's Ancova Energy Markets, ANCOVA. We send out once a week newsletter that has energy pricing, market commentary. I think you'll like it. Check it out. That's Ancova Energy Markets newsletter. This episode's guest is Jamie Hurd, manager of capital markets at Tourmaline Oil Corporation. Jamie's also a great follow on oil and gas Twitter, where he provides regular market commentary and quality analysis. You should check him out on Twitter. I will leave his handle in the episode description. This episode, we discuss investing in energy right now and what Jamie's paying attention to in the oil and gas equity space. We talk natural gas fundamentals and his views on supply-demand dynamics into the future. We talk about the recent increases in the cost of capital and how that will ripple through and impact the infrastructure industry. And lastly, we riff on natural gas's role in the electrical grid and how we see that landscape changing. Hope you enjoy the show. Jamie, welcome to Talk Energy. Thanks for coming on.
Thanks for having me.
Yeah, so we know each other from Twitter. It's like a lot of my guests. I always say this at the beginning. It's like, follow interesting people. Love the stuff that you put out. It's very analytical. You got a bunch of great tweets and commentary, and then you retweet a bunch of good stuff about what's going on in the oil and gas markets. And I looked at your LinkedIn, also noticed that you have a CFA. Is that right?
Yep. That was
props to that, man.
The stripes.
Yeah. Props to that. I tried it back in like 8 or 9 years ago and got to like the second test and didn't pass it. And was like, I don't know. I'm going to do this. So I always bring it up to people because I'm like, I know how crappy it is to do it. It's a brutal brutal test.
Worked out. I was able to get my first 2 levels done while I was still in school. So then it's studying while you're studying. But for level 3, I was banking first year, and I was a mess. Like it was shoestrings, and my fiance at the time pulled tons of weight. Tried to give me as much time as possible, and I squeaked her through. But it's super challenging, especially when you make the transition to actually working. Because then it's not natural to buckle down and do 8 hours a week studying or what have you.
Right. No, it's tough. And for me, it was like kind of just a hobby. Like I didn't really work. I was more in like commercial and midstream, and I really wasn't doing anything where I would need to learn that. I just was like, kind of just thought, hey, this is interesting. It would be cool to have. And, I was like, it can't be that hard. And I remember sitting there in the second test, and it was like, these 2 girls on either side of me, and we're like chatting a little bit kind of before it starts. And one of them was like a, double like accounting finance major. And then she had gotten like a degree, like a master's in like quantitative methods. And like the other girl was like a CPA with like, a master's in accounting or something. And I was like, golly, great against these people because they like score you against like the people that take it.
No, I know. And the pass rates are terrible. I think like it's 30, 50 or something like that. It's grind.
I didn't mean to like get into this, but the CFA, the part that chapped me was the pass rates. And I just felt like you start to do the back of the envelope, and I know you can't say anything bad about them because you have a CFA, but
8% of the people pass each test on the first try. Like that's a ridiculously low pass rate.
And it's a ridiculously profitable business model. So they tell you to, they give you all these ethics. It's like drilling ethics in your head. And you're like, well, wait a second. For every person you fail, that's how many millions of dollars in test fees that get funneled back. So I don't want to get in trouble. So we want to go into the politics of the CFA there, but it's impressive. That's awesome that you have it. I think it gives you a really, really good skill set to be able to analyze things. But for the listeners that don't know you or follow you, some of your background to start, and then we'll jump into it.
Yeah. So finance background. So I was always interested in the finance side of the business. So did BCom, Masters of Finance, and then did banking. Was really happy to get into energy banking. So did a couple of years with Barclays in Calgary, and it was right at the end of the shale boom where Asian NOCs were quickly buying up assets. And so had the opportunity to work with a great team, and we did shale gas for the most part. It was PetroChina buying in Canada's Duvernay at the time. That's a JV that has since dissolved. But then also the Mitsubishi transaction where they bought in Canada's Dawson. And that's actually probably the most successful deal in the patch from a big scale of that JV concept that's had the ability to stand the test of time, and fell in love with natural gas from there. So worked research, worked on the E&P side at BMO, then went to the hedge fund world, did a couple of years at Citadel, again, E&P, and then kind of a hybrid analyst PM role at Castleton, which is a merchant, where I was helping them with their supply modeling and their crude and gas bets, but also running an E&P book on my own. And the entire time, I definitely felt much more passion and interest on the gas side, and that's often where my best ideas were. And I've carried that into my current employer, Tourmaline, where I help them out on the capital market side. And that's kind of been the dream come true, getting inside the beast and learning natural gas from the inside. And plus the breadth of people here to work with and learn from has been great. And so as far as what I, interact on Twitter that's been a great learning ground for me, putting ideas up on either investing or gas and then getting feedback. And there's some areas that I'm weak on that I've learned a ton. And a great one is like infrastructure, understanding exactly how infrastructure tools are set and stuff like that. So it's been a total pleasure on that side of the platform.
Yeah, it's great. It seems like you've gotten to learn a lot in your career. And I think that's sometimes you just get lucky. Like I worked early in my career at Chesapeake and we were like doing all this stuff and I like didn't know it at the time, but you look back and you're like, I was actually pretty fortunate to just, like as a young person in your career, it's like you want to be put in these positions where you can just learn a lot. And it sounds like you've had a really good run here on just getting a ton of knowledge. And then interesting on the Twitter stuff, it's like I had not been utilizing that as a tool until about 2 years ago and really wasn't on social media at all. And then kind of realized there was this, I would get somebody sending me like a tweet from something like from oil and gas stuff. And I'd be like, that's interesting that they're talking about this. And sometimes it was analytical. Other times it was like the rumor mill of like what was happening like in the industry. And then sure enough, a lot of those rumors would like come true. They're like, hey, like this person is going to get bought or something, and you'd see it on Twitter first. And so you're in Canada, right?
Yep.
So do you identify as like Canadian oil mafia or like EFT or like what's your?
I haven't put any of the hashtags on my profile yet. I definitely interact with lots of these guys who are in those cohorts. I haven't I guess totally found a tribe. And that's an interesting part of Twitter that I guess I'm less engaged with is I definitely know people who find it to be a huge part of their social, infrastructure and their network. And that's who they converse with. And there's just there's some people I follow that, you can see they get home from work and that's where they spend their time. So I haven't done as much on that side, but definitely there's lots of good ideas from each of those camps. But I'll fly all flags. U.S.
I just didn't know if some of these Canadian oil mafia people are like really trying to stake the, draw the line in the sand and be like, we're our own thing. And I just kind of laugh because I don't really like identify with whatever. It's just an observer and try to participate. And I will say meeting people in real life off of Energy Twitter has been great. And I think that was like a surprising thing because at first I was like, oh, there's just all these anonymous accounts. And then you realize I think I realized about 6 months in, I'm like, all these people know each other like in real life. Like a lot of them do, you know? And then you're like, wait, some of these people are like I'm in Oklahoma City. I was like, some of these people are here. And so I've like met people and go to Houston and do like meetups with people. So it's actually a pretty cool networking tool. And it seems like one thing that people are really interested in is the investing side. They want to talk about certain companies, certain stocks. I've never been big on picking stocks in oil and gas because I'm always just exposed to it anyways. And so I'm like not as much into it as I probably should be, but you had mentioned investing in oil and gas is kind of one of the broader themes. And I've got a bunch of more like specific things and then talking about macro and some other stuff here in a little bit, but just your general thoughts on the current environment backdrop and just as right now, your thoughts on investing in the oil and gas sector, particularly through the equity side.
Yeah, well, obviously what a change. Like if you were owning energy or equities in energy 3 years ago and you held on, you've done amazing in almost anything you've chosen. It's hard to have not hit, but it's been a total learning curve for me. I would say when 10 years ago, when I was on the banking side or the hedge fund side, I was very much, okay, value matters. Let's focus strictly on who looks mispriced to the downside. And I definitely came at it from a view of, these are all factories that are producing widgets. There isn't that much differentiation between company to company. And so mispricings should get solved through acquisition or just the market realizes it's mispriced. And I've come a long way away from that since. I now fundamentally think that energy businesses, especially on the E&P side, definitely make their own luck. And there's a ton of strategic advantage on the marketing side, on having enough scale to, have control of your services, et cetera. So that, like, if something is trading 2 turns more expensive than something else, I no longer is like, it's premium is too expensive. That's too high. It's understanding why the market's ascribed a bit of a premium there. And so one of the things that on this part of the cycle, so right now we are at pretty good prices for both gas and crude. Inflation started to grind into the E&P margins a little bit, but in general, people are having, incredible cash flow relative to their encumbrances, whether it be debt, which many of them don't have anymore, or the capital. And so they all look like very, very healthy businesses. But when you go one layer deeper, margins are still very different. And so you can have a business that has an EBITDA margin or an income margin or free cash flow margin that's still double what another business is. And so that's important if we're looking forward for the next 5 years. I think my view is volatility. We're going to likely continue to have very strong prices, but probably some volatility in there. And if you're owning a company whose margins aren't as thick, that 10-cent change or dollar change has a far greater sensitivity to your cash flow outlook on the forwards than the business that has a much wider margin. And so that's kind of been a theme of something I've been trying to, put ideas out around or think around or engage around is, margins definitely matter. And the market actually doesn't appear to me to have correctly rewarded margin. I think the other one is obviously inventory. We can get into that later, but on the just financial metric side, margin seems to be an area that I think there is a real financial opportunity from just striding a portfolio and thinking about, okay, what's a good investment versus what's a more risky investment.
That's a really good point. I had David Heikkinen, I don't know if you've seen his work, and he used to come on the show quite a bit. He's got a new role now where he's doing more carbon capture, but there for a long time, we would do kind of market updates or weekly talking about it. And he was on the buy side for a lot of years. And one point that he made was that he was kind of shocked at just how there are less analysts now. Like he was looking at some of these shops and it was like, they had added 30 energy transition analysts, but then they had like 10 or something traditional energy or 8, or they had like gotten less. And do you think that like the coverage of the space has gotten less in the years where it was less popular? It wasn't, this darling that it is today. Like kind of randomly, it just has popped back up. And to the vindication of a lot of people that had been saying it was due. Do you think that is true? And does that cause opportunities for guys that are willing to get in the weeds and do the work?
Yeah. And I think, definitely you're seeing analysts now who used to cover maybe a dozen stocks. Some of them are covering up to 40 stocks.
Wow.
And you're not going to be on top of it enough to catch thematic. You could have thematic trades, but in terms of just being in the weeds enough to be able to avoid some of these blowups, that's going to be really hard if you're covering 40 stocks. My experience is on the large caps, coverage is still pretty good. There's definitely you have to know how to ingest sell side research. So if you're on the retail side and you're reading a report, that report is a very thin veneer of what the analyst probably ultimately thinks about the story or the stock. There's a whole context below that where you kind of have to be able to get on the phone with them, get their model, et cetera, to actually understand the real pushes and pulls on what the bull case is and the bear case is. And I think that has continued. MiFID and Basel III have pushed research into such a corner where it's hard to have true objective research. Now, David at Hike was an anomaly, and there are still some anomalies where it's kind of hard-hitting research. They'll say some things that sometimes their corporate clients don't like. That's super rare. But if you're on the mid-cap side and the small-cap side, can be a total vacuum. There's very few shops in Canada or the US that I observe to do great research on mid-cap. So if you're looking for, okay, how can I get an outsized opportunity to, discover a true mispricing or to, express something in the mid and small cap space, I think that's an opportunity. The contrary there is, though, I don't see a driver to relink valuations in the mid or small cap side because there's not a reason to own a smaller mid cap business versus a large cap business, because the return profile of large cap business is often similar, and they have some structural advantages that likely compound over the next decade that I think the large institutions are aware of. And the large institutions who have been in these small and mid cap businesses kind of feel a bit stuck. So if you ever do get a smaller mid-cap business that, does go on a bit of a run, there often is a flow of sell pressure as guys are trying to crystallize this sometimes 10x they've enjoyed relative to where their cost basis was 4 or 5 years ago. So that's a structural headwind. And then also just in a world where, access to services matter, marketing matters, investment grade matters, there's lots of structural headwinds that are just going to constantly keep pushing the chips towards, the super majors and large businesses.
Yeah, that's a good way to put it. Thinking and caveating all this with this not investment advice, people, but if you think about people that are amateur, I've had guests reach out to me, and a lot of people are kind of amateur oil and gas investors. And so I try to cater to that crowd sometimes with episodes like this, where we can talk more about the investing side and also the capital markets and just kind of some of these macro themes. People that maybe don't have the tool belt that you have with the CFA and with, being in the weeds and understanding, really granular details like inventory and marketing and margins and all this stuff. What are like the top things that, as these guys like maybe read some tweet from Canadian Oil Mafia of like, hey, buy this, whatever company or this service company? I mean, what would be like some high level advice for the amateur investor if they want to try to dip their toes into trying to pick some winners versus just going with the safe bets? I mean, is there anything that they can do, or is it or would your advice be like just stick with the larger ones?
My general advice is there's not a reason to go bargain hunting right now. And yes, if you do a screen, you can see some eye-popping dividend yields or free cash flow yields. You can see some multiples below 2 turns, and you can very quickly talk yourself into, wow, this business can buy itself with its free cash flow in 4 years or whatever the narrative may be. All those things are true, but the return proposition offered by the stablest, largest businesses is so good that you don't have to take that incremental risk, because I guarantee you, in the long run, of those 5 amazing small cap stories, 1 or 2 is going to have a massive surprise to the downside over time. And it's just something that happens in the market. So my first impression would be, I would hang out in the best high quality names. And the caveat there is inventory, I think, is really important. So where could a big company hurt you is a big company may have to do some really dilutive resource acquisitions over the next 10 years if they're falling off their treadmill. And that's something that a large business has just as much exposure to as a small business. But a large business will have the advantage of being able to, sign up LNG contracts or sign up into preferred toll agreements on the crude side, have good diversification, and then, balance sheet better be stellar. If someone's looking to say, hey, like, not only am I looking to invest, I just want to spend the time and really work here. I think if you can get, some sort of asset subscription, whether it be, there's lots of them now. Like I've seen Flow put up a bunch of good stuff. Obviously there's the big packages like Embarrass or GeoScout, et cetera. But if you can work around where you think, some of the last vestiges of kind of resource exploration are going to be, those could be some really cool home runs. Like, EOG just announced their crude Utica play. There's a ton of stuff in Canada that is going to have to get spoken for over the next 5 years. So if you can develop a view that, it's a small business, but they're operating themselves in a responsible way, and they have a resource prize here that is going to be extremely valuable in the next 20 years, that's a differentiated way to play the space and worth the effort. Yeah.
That's good. What about like this differentiation between Canada and the US? You got some people saying that they've got a bias towards Canada. Is there really anything there? Is there a disconnect in valuations? Is there a premium maybe that could be had? Or is that just kind of like you're not focused on these Twitter narratives of like broad geographical themes and you're more focused on the value in these equities themselves?
Oh no, like for borders matter for sure. So like some things I think you can count on in either country. In the United States, things are going to move faster. If a business wants to pivot and explore, the rise, and I wouldn't say fall, but maturation of the PRB, how the scoop stack kind of like came from nowhere and was a big thing and how it's totally retrenched. Like all those cycles seem to happen way faster. Haynesville's going to debottleneck in effectively 12 months here. We're going to get pipes on in Q3. Permian's putting a bunch in. They're going to be debottlenecked by 24. Like all of that stuff happens 3 to 4 times faster in the United States. And so that's worthy of some valuation discretion. If you're tracing a growth story in the US, likely that growth story is going to have some tailwinds on that side, just because it's easy to build pipe in Texas. Where I get excited on Canada is one, on the oil sands side, like that's an inventory and resource life boon that is debottlenecking with the TMX pipeline. And you can look at Canadian oil sands business model or some of these other oil sands business models, and you're saying, okay, if I'm believing a long-term oil demand on a 10 or 20 or 30-year stretch, there's a huge harvest window ahead of me that actually could enjoy extremely good margins. Once we get TMX on, Canada is going to have effectively the only straight shot at the two refining hubs in the globe, being China and the US, which is great. So to have a major Pacific terminal is going to be great for those guys. And on the gas side, the Montney is far less developed than all the other US gas plays that have access to market. So, the quick math is roughly the Montney would be, less than 5% developed. It's kind of 20 T's on 800 T's of resource. So there's a ton of running room there. And I think that's going to be really important as the US goes from exporting 12 B's a day, to the low 20s. You add in Mexico and Canada, we're almost in the 30s, we're definitely high 20s. That's a huge, knob of demand that's going to need inventory to feed the beast. And I think as companies are trying to arrange themselves to participate in that, that's a key tailwind for Canada. The other part of Canada that has historically been, definitely a good little tailwind is it's own little microcosm, and it's consolidating in a really nice way where you're going to have, kind of a service market that's right-sized. You're going to have infrastructure market that's right-sized, and there's going to be natural owners in each kind of fetch area. So you're not going to have, like, I know, in some of the more competitive US plays, there's a bit of an arms race to, on frac barriers or making sure you develop this part of the play really quickly so you can access this pipeline before the other guy does. Like, that's still, that fragmentation and that frantic pace can still cause some lumpiness in capital and delivery.
Yeah. No, that's good. That's good commentary on the differentiation. Let's talk about just natural gas broadly. And it's been what I would call it's been interesting. I know you've been interested in your career. I've been like living and breathing it, but it's been like kind of boring in some ways the last, however many years, call it, since like the last decade, because you're kind of just like, we're in this sort of, production growth is going to go up forever. It's perpetual. We're just going to we can add as much production as we want. And you have like the Northeast adding huge chunk of the overall mix that's come online in the US, something like over 10 BCF or something like that. You could probably tell me the exact number, but a huge portion of the wedge coming from that part of the world. You had the discovery of all the major dry gas shale plays, and it was just conventional wisdom that gas is basically going to be cheap forever. And that there was just sort of this range bound kind of $2.50 to $3.50 gas price. Last year has been pretty interesting. So before I ask you some specific questions, just give me your overall broad thoughts on natural gas markets right now.
Yeah, you're totally right. I think once we kind of got into the real shale boom and you had the Permian growing at a pretty frantic pace, right, the associated gas adds out of the Permian were averaging around 2 BCF a day a year. And they didn't really care what the gas price was, right, at all. And then you're right, Marcellus, when Nexus and Rover were coming on, was, it appeared as though it was going to be easily debottlenecked. There was a bit of an arms race there for sure. There was definitely a lot of capital being spent without much respect to the need to have some free cash harvest. Yeah. And so it got dire. And I think that actually enforced a ton of discipline in the space. Like, the businesses that have survived the last 10 years have survived either because they were able to put in place a cost structure in order to survive and thrive, or you've had some massive reorgs. So if you look at the Haynesville today, much of those gathering and transportation contracts effectively had to be reorganized and reset. They were just done at a way too high of a mark. But now we've kind of pivoted, and we've pivoted for several good reasons. But the Permian isn't developing nearly as fast as it was before. We're at a far lower growth rate, so that associated add is far more manageable. The Marcellus is struggling to debottleneck. MVP is the last main pipe on the radar in a meaningful way that could potentially participate. And even if it does, it actually is more of a South Carolina, North Carolina pipe. Only about 500 million a day can get over and participate in the Gulf market. And so who's adding gas? It's Delaware, it's Haynesville, and then it's the Canadian Montney and the Canadian, the WCSB in Canada. And then you do get a little bit of ads from plays like the DJ and the Bakken, et cetera. But in general, the Rockies have been on decline. So your supply knob has moved way back, and now demand is cranked up and is about to explode in 25. And that's where you'll link, the North American continent in with the global continent, and you're going to have a totally different gas picture.
Yeah. It's interesting because, to your point around the debottlenecking, I think I saw in the Northeast, I think I saw a chart, maybe you retweeted it, but is it production closer to like 2019 levels right now? Is that what I saw, like in terms of production coming out of that area? Like it's been flat or declined, or am I wrong on that?
They've had constraints, and some of the operators in Appalachia have been pretty open in this quarter, and that, hey, we're having system constraints. That are some of these things are supply chain issues. Typically, Appalachia's gotten into a pattern of having seasonal production because they can ramp supply into local demand. So I think once you do get the Northeast cold, you should see a blip up. Typically it's kind of been a B of seasonal demand, and that goes into those local power plants, but they are truly stuck. And kudos to them, frankly, for understanding how stuck they are and managing production in a way that Leidy's not zero every day.
Right.
It could be like that. But they're self-curtailing, they're bringing gas back and enjoying reasonable local gas prices. They're not great, but they could be worse. It could be kind of the Waha dynamic. And it's with your recent election results, which we follow closely up here north, I don't think there's a massive reason to expect a change in policy.
Yeah, it's looking like that's going to be the new path forward or the new future. Even this week, I don't know if you follow the cash markets, but what my business does is we have a natural gas marketing shop, and we primarily help small and mid-sized guys. We're not out doing a lot of day trading. It's more just kind of helping people move production, getting access to markets, helping with their midstream stuff. And we do track, gas daily pretty closely. A lot of our clients will sell first of the month, some, and then they'll have exposure to the dailies. And huge shock to that system just this last week, and primarily, I guess, weather driven, but some pretty extreme differential blowouts. And then even just, Henry Hub on the cash basis, but you're seeing in the dollar something gas in basin in the Northeast, in Oklahoma, where I'm at. And then the Permian, we've seen the Waha blowing out. It's gotta be, that was a little shocking to me because it's like I tell people all the time, clients ask me like, hey, what's natural gas going to do? And I'm just like, whatever I tell you, I'm going to be wrong because I don't know. But I would have thought that, this year's just been crazy. Like we've seen the cash prices go to like $9 and you're selling $9 gas. And we've seen basis like shrink really small, like in the mid-continent area where we have a lot of product. And then we see this really quick blowout and then you're at $1 something, which has really been kind of since like 2019, since we saw prices that week in basin. Really, even in 2020, it was maybe got under $2 a little bit, but it was kind of above $2. And then last year was pretty healthy. And so is that surprising to you, or do you think that this is the new normal? Because it was a little surprising to me just how quick that move was.
Yeah, it was very unique. So what surprised me is how soft we were this fall weather-wise. Like we did 10-year record plus in many jurisdictions. And so basically the dynamic that we saw occur is you had very, very little demand on the weather side, whereas the storage guys are probably expecting some demand, frankly. So they're filling faster than you expect. And then the forward look to November gets more and more enticing. So those cash prices, you're right, $1, basically everything, east of ACO, so east of the Rockies, got absolutely trucked for the last 2 weeks, and it's just so warm. Like New York was 24 degrees. So the storage guy's like, well, I got November, I got terrible demand here, and they're just burping, right? They thought they were going to be able to in a position to start withdrawing soon, and they're full, and you get these regional dislocations where this storage guy says like, I'm maxed because I was holding on to start selling back. So ultimately, I think that converts. I think your forward financial prompt is still really healthy in all these markets. The other one that we, at home, so it's minus roughly 20 degrees today. It was minus 25 Celsius. So, well below freezing out here in Alberta. So our demand ramped. and we couldn't export anywhere. We were actually bringing gas back effectively from Ontario. It was because of that weather issue. So that is kind of what you're saying. The volatility will be high. I think we will have weather events that plow through the north, the continent, and that could go through periods of extreme tightness. The more mature the gas production, and you would actually have a great perspective on this in Oklahoma in your old Chesapeake days, but now we're getting more and more of these stripper wells that are doing tiny little bits of gas. You get some cold into these old legacy fields, the freeze-offs can be big. So not only in the winter will we ramp demand, but we'll also lose supply. It's quite a shock to the system. The other thing that kind of wrecked November was the Freeport delay. So we now understand Freeport to be more of a December event. I think many storage caverns in the South would have been positioned to try to sell into some of that incremental demand. That incremental demand is a month late. So it's going to be volatile. Definitely it's going to be a West versus East story a little bit as well too. I think the West we are a little bit more constructive on. But I think that'll be kind of a story that continues to play out over the next 2 years. It'll be high vol.
Yeah, I agree. Back to those days, there didn't used to be there for a while, like the storage game, the trading game. When you got this really just steady kind of band, it wasn't as exciting on those opportunities. And now we're getting $9 gas, and then in like the shoulder months randomly, or like I guess it was in the summer technically, but we saw it shoot up in the shoulder months, which was kind of crazy. I think that was the biggest surprise to me earlier this year, was not the move of gas, because we've seen it go up, and we've seen it go up quickly. It was the time of the year that it did it. And what do you think, like how big of an impact do you think the European situation has on the US and Canada in terms of like what's going on over there? Is it just kind of tangential, or is there more of like, I mean, obviously we have more LNG export, but how much of an impact does that have? And will it continue to have more into the future?
Yeah, I think it was an early time this year story for sure. Like when we were at $9, I think many of us who are looking at the fundamentals are head scratching a little bit, especially when coal hadn't quite ramped yet. I'm like, I'm not sure we need to be at 9. Like seven seems to have balanced us. But earlier in the year, when you're looking at the probabilities of how production and demand will fluctuate through summer, winter, there was a small chance that, call it a 10% chance, if we have a hot summer, not a ton of supply growth, call it middle of the road supply growth, and then a cold winter, we could run out of gas here. And if we run out of gas in North America, what's the biggest knob that's going to change? You're going to have oil switching as some industrial demand shut off, and then you're eventually going to have to turn off LNG. And so when you go through the price points that would result in those kind of factors switching over, when JKM or TTF was at $50, $50 less shipping, call it 45 or 40, 44 depending on the day, that you could realize that in March. So if there's a 10% chance of $40 Henry Hub in March, that sways the entire calendar up $2. Right. That was, and we have diminished those probabilities over time as Freeport got knocked back, and we moved through the summer. But those probabilities will rear their head again when LNG is big. When I think about how Europe influences natural gas for 23-24, what's interesting to me is the industrial arbitrage I think is going to persist. So if you're a fertilizer producer and you can produce either in Europe or North America, it's a no-brainer. Produce in North America, consume the ammonia, ship it over. And all of the businesses like that, I think, should have an incentive to invest in capacity in North America, increase your industrial production here, ship over, because then it's kind of that theme where everything is an energy arbitrage. There's going to be, I think, room to move that ball forward. And we saw a bit of industrial demand growth this year, but I think one of the things that could surprise the upside is industrial demand growth 23-24 on kind of those items. And then as you're moving into 25, it'll become strict ARB economics, where you have, this switching argument. The other thing that I think is going to be really interesting to watch is not only are we building a ton of LNG capacity in North America right now, but we're also signing a bunch of contracted capacity. And so what could end up happening is, because of this capital intensity of this build and how these contracts work, is you could have a fair bit of fixed LNG out. So if you have someone who's saying, this is a take or pay, I want your gas every day for the next 20 years, it's coming to Europe, you're my guy. That's not a variable molecule anymore. And so when you're going through these global price shifts, US will be more all on. And so that firm out has definitely implications for how S&D is going to work here. back into the decade.
Yeah, that's interesting. What about the LNG story? You mentioned 2025. We kind of know like the pipeline of new projects that are coming online. Like when does that get to a maturity level global, like in the US and then globally? Like when does it get to the point where we're like, all right, they've built enough of these things and we're linked up enough? Like when do you think the LNG story gets to a mature place? Because it hasn't been that long of a story so far. I mean, I remember early in my career, it seemed like this was just some far off thing. It was like you talked about it, every 6 months you'd read about it and you're like, oh yeah, one day we'll have this. And now we have it. And then the growth has been rapid and clearly changing the way the markets work. But when does that start to level off and get to maturity and where it becomes more of like, this is just the new normal and we're not seeing these huge tranches of export coming online?
I think we've kind of cracked the nut enough on cost. Like greenfield LNG is, call it plus minus $6. You need a $6 kind of cost recovery ARB and OPEX ARB. That is now at a point where we could be in this stage for the next several decades. And so like when I look back historically, we've kind of added natural gas demand as a globe at around 7 BCF a year. Every single year, there's about a 7 BCF add in new consumption. When you're thinking about, okay, who's going to answer the call of this growth over the next 50 years, and why we could back up to like why we think natural gas is going to be a crucial baseload fuel for generation. We can get into that later, but suffice it for now, we're going to be on a very strong demand track. Where's the resource going to come from? Well, Russia is going to repoint to Asia, and it's going to take them time to do that. The Power of Siberia 2 sounds like it's going to take about 8 years to get that gas over to China. Wow. And then Europe is going to try to consume as much gas as they can from, safe nations, G7 nations, the Middle East nations that they've been able to contract with. And then there's supply issues in some of the old legacy basins. Like Australia is struggling. You're seeing some of those platforms start to water out and decline, and there's some asset reallocation where they're moving platforms from one asset to the next.
Interesting.
And so I do think that we probably we'll have surges for sure. We're not always going to build 15 Bs every 5 years. But when we look at the docket right now, you're trying to get Mozambique on. We haven't had Mozambique on. It's been having tons of security issues effectively. Right. We were supposed to get the Novatech plants on from Russia. Those aren't coming because Baker's effectively pulled support on parts. So you're not going to get those ads. Those are supposed to be, it was roughly 2 Bs a day. There was going to be the only ads before 25. And then there's not a ton globally going on other than Qatar and North America. There's cracks. But Qatar and North America are kind of the end of the decade picture. Well, who else is going to, make the jump ball here? When you look at the cost curve that, Goldman puts out a LNG cost curve every year, which is great. Qatar and North America are at the low part of the supply cost. And so until that changes, until you've ramped up enough that that's more normalized with other jurisdictions, I think you could deploy LNG for a long time. And it's interesting to me, like you're seeing several plants proposed off of the Pacific coast of Mexico. Canada obviously has its LNG site. So people have put the dots together, and now you're having 3 jurisdictions at the exact same time put, some of the biggest projects, like LNG Canada is Canada's largest industrial project ever. It's, I think, about a $40 billion spend. It's breaking, all those records. And so that, I think, continues.
Yeah. What about like on the import side? You're talking a lot about the export side, new demand growth. Is there, I don't follow that as closely. I'm more, to be fair, more focused on production and, where it's coming from. But what about where it's going? Do we have a clear path on where maybe new markets may be springing up? I mean, obviously Europe right now trying to decouple from Russia, but just any thoughts on the import side?
Yeah, like Europe is obviously the big one. If you're looking for a fly in the ointment, Japan, right, re-embracing its nuclear strategy, that's probably one that isn't as robust as it would have been in mindshare 2 years ago. But the surprise ones for me is the China plus one. Like you used to hear about this China plus one manufacturing. Like, okay, I want to have a big plant in China, and then maybe I'll do one in Cambodia or one in Vietnam. Those investments in that kind of trade have spurred really good demand in India, Cambodia, China, name your China plus one country, and their consumption of LNG is definitely increasing. And they all, outside of India, many of them fly under the radar because by country add up to big quantums. But in aggregate, they definitely do. The really interesting thing right now is not only has China clearly been price sensitive this year, they're behind on their imports. They're also obviously in lockdowns, but many of these other countries are definitely very price sensitive. And so it's this big floor in my perspective. Like once we grind LNG prices into the 20s, high teens, I think the growth you'll see will be a really big rapid step change, which is super necessary to incent those greenfield adds. Like you need to have a really sticky LNG price in the teens to make those, 30, 40, $50 billion investments to bring on a greenfield LNG plant, counting on resource at home to be in the mid-single digits.
Yeah, that's a good way to put that and think about it. The thing that always strikes me with these LNG export facilities in the U.S. is it's a lot of gas. I mean, if you think about the long-term nature of these contracts, and you're like, this is kind of leading into the next topic, but okay, you add, like, let's just say something adds a BCF a day, and you're like, okay, a BCF a day, and you think about that, but then it's like a BCF a day for a long time, and it's going, yeah, right, and so that's a ton of gas. Let's talk about inventory for a second in the U.S., and we can talk about oil too with this conversation if you want, but just one thing the last 10 years is a lot of companies, like on the gas side, were kind of in survival mode. They have a lot of gas, so maybe they weren't as concerned about inventory. And even on the oil side, guys, basically since 2014, haven't really, exploration's been down. Everybody's been kind of like limping along. Debt levels were high. They're getting better now. But a typical company, has like a good company, 10, 15 years of inventory if you're like really good. And, guys really weren't doing exploration and really probably weren't doing as many acquisitions. So just like, what does the inventory levels look like? And you hear a lot of rumors of like, hey, shale is like peaked and, you're just going to see things getting worse. But just your thoughts on inventory and quality of inventory and what that's going to look like, not just the next 5 or 10 years, but long term. I mean, these are seriously long dated infrastructure projects that are going to need feedstock for a very long time. It's just an interesting topic to me.
No, this is definitely a pet interest of mine as well. So, you're seeing conversations evolve real time that point to, okay, not all is well, or not all is necessarily as it's been communicated, but for sure, like even on its face, 15 years, that's maintenance. We definitely need growth. We're going to add, call it 20 Bs on a 90 B stack. So we're adding 25% growth on our current production. So if you're going to grow your E&P production, your 15 year was on a maintenance. If you're going to add any sort of growth CAGR, that 15 becomes 10 in a heartbeat.
Right.
But what we're clearly seeing now is, in my perspective, we're starting to slip on the tiers. So we're going from tier 1 to tier 2. That's starting to evolve. And you see that with, okay, half of our mix this year is going to be Haynesville and the other half will be Bossier. Okay, well, Bossier's, 20% less productive, which doesn't sound like a big change, but because free cash margins are, call it, 50, 60%, that means your free cash margins shrunk by 40 on that Bossier slice. So as you start to slip into these less productive tiers, things magnify quickly. The Marcellus, a lot more discussion on the upper Marcellus versus lower Marcellus. Like I remember 4 or 5 years ago, Cabot wasn't even really doing much on the upper. They were putting a well or two in a year. And now we're hearing that some of these companies up here are going to be doing significant parts of their program. It's going to be, 30, 40% of their program. You're doing that on purpose. You're not doing that. You do that because you have to. It's, if you had your dithers and you had your inventory, you would drill lower all day long. And so there's going to be that slip. And I think there's going to be some chunks in the supply cost dispatch. I'm not saying that we run out of, tier 1 inventory and all of a sudden it's $8 supply cost. That's not my call at all. But my call is that as we try to ramp these basins, especially the basins that are able to establish egress to participate in this LNG export, demand trend, there's going to be a shift in the haves and have-nots. There's basins that are rich in inventory, and they have decades and decades of rock that's going to deliver at a supply cost that's very similar to what you're seeing today. And then you're going to have a basin that grinds up and starts to do more tier 2 rock and starts to do more, fringe rock. And you're going to have to drill more wells for the same gas. So your treadmill is steep enough already, but now gets even steeper from a capital perspective. And that's going to have real implications from an investment perspective. Okay, I own this business. the efficiencies looked good, but now they just bought a ton of resource with very little production for a lot of money that looks very dilutive on a cash flow per share perspective. Like, why did they do that? And they did that because they're trying to reload for the next 10 years. And to your point earlier, exploration used to be enough to give you the 1 or 2 year extension. But now the beast has gotten big enough that some of these businesses are doing 2, 3, 4 billion cubic feet a day. You got to be adding entire plays basically every 5 years, and they got to be successful. They got to be supply cost plays that can compete. So I think there's going to be a bit of a resource grab, and it's going to be kind of done behind the scenes, in my opinion. I think you're going to see businesses acquire the resource before they talk about it, because some of these acquisitions are going to have to occur in ways that are, kind of detrimental to the impression on what the share value is today. So it's a super interesting game theory. It's a super interesting strategy conversation that I think is, probably heavily being debated in many of these, boardrooms today, because it's going to shape a huge part of investor return and where gas comes from over the next 15 years. And then over top of that is a really interesting infrastructure angle where, some places you can't build pipe, some places you have to build a lot of pipe. And that pipe is going to come in at a far higher cost than it did before. Yep. So if you're in an area that's congested and you got to build pipe, before maybe it was like $1 toll or 75-cent toll. Like there's good reasons and there's good threads to understand that could double. And so it's not only where you have inventory, but do you have inventory in an area you can slide through declining basins? So this is the Montney's. This one is like the Montney is gobbled up. The Piceance, those basins the Piceance and Green River used to supply California. They declined. The Montney was able to slip into some of these depreciated lines and kind of get to California for $1 relative, not $2, what it would have to be if it was building on top. The Bakken's the next one, right? So can you slip through some of these Bakken egress and get into interesting areas without having to build a ton more pipe? So the next one to watch from that thread will be the Eagle Ford. Can the Delaware slip through some of these Eagle Ford lines, get to the coast without having to build a bunch more pipe?
Maybe. There's a lot of gas in Eagle Ford too. And if you're building a pipe, it's a shorter distance. So
that's true.
Some of these guys, I've like some of the challenges on the Permian side. It's like, if you're a guy that, you're a pipeline and you have a choice, it's like, well, I could get a lot of gas here. And I know just from some of our clients, there's some pretty material constraints in the Eagle Ford that will get resolved, but there's going to be some new big pipes built. What's crazy to me, again, back to the treadmill, is just like when you add a BCF a day, given the nature of the declines, and this is just kind of shale 101, but for maybe people that don't know, it's just so steep. So an older BCF a day that's in a legacy area, that's in a later part of the decline curve, is not created equal to the new ones that are the incremental ones coming on. And so it's not that we just have to add it. It's that the stuff that we're adding is then depletes so much faster. And one thing that I don't hear talked about a lot, and there's a couple of people that have talked about it, like Stacy Sim on Twitter has mentioned this about studying decline profiles, but it's pretty interesting to me. It kind of gets lost. You talk about inventory locations and we talk about a lot of different things, but just understanding these different assets and where they are in the life of their decline and how that's going to impact it. Because on those incremental Bs, that treadmill is just going so much faster. Yeah. So,
and you see it on free cash flow. So like you can, and this is classic in the Haynesville. So the Haynesville, you look at operating margins, like, wow, like there's no real realization discount. Yeah. Now that these Williams deals have been restruck, the LOE's like tiny, op costs are tiny, it's dry gas. This looks great. And then you look at the capital burden to keep you flat. You're like, whoa, what's going on? Yeah. And it's, these not only do the wells decline really fast, but they've ramped it really quickly. The privates and publics alike, publics have slowed down. But that's going to take time for sure. Yeah. That's the truth is in the pudding. You can ask a company, you can model a company, what's your decline rate? But the check is like, what's your capital intensity to keep this business flat from a cash and capital perspective, and imputed with the free cash flow. Yeah.
It's pretty interesting. What about like infrastructure and the cost of capital? That was a great thread that you had. I just retweeted earlier because I was looking through your recent tweets to come up with ideas to talk about. And the cost. I don't hear this as another under discussed narrative. I feel like in the Twitter space, maybe it's out there in the research, but just like the rising interest rates, you hear a lot of talk about, the obvious, like real estate or, the impact on tech stocks. But it's a real thing. I mean, cost of capital is a big deal. If you're an energy service company and you have a really tight cash conversion cycle, you have to spend a lot of money, then you're on net 60 or something, and you got to get paid. And these guys rely on lines of credit. If you're a marketing or trading shop, you rely on lines of credit. And if you're a infrastructure provider who in the past looked really attractive with a 10% rate of return or some lower rate of return, 8% or something, and now you can get a risk-free rate of return of 5% or something, or wherever it's going. What's the impact broadly going to be, and then specifically on infrastructure?
Yeah, I think there's two components that are super fascinating right now. So on one, many energy stocks have been bought en masse. There's been macro buying, et cetera. But what's the part of the ecosystem that isn't the prettiest girl at the dance right now? It's probably large pipeline businesses, large infrastructure businesses. And it's because they have a lot of debt that is starting to have to, okay, we're going to have to refi at double the rate. And they don't have the growth yet. There's definitely exceptions. Like there's some LNG exposed midstream companies, and obviously the liquefiers themselves that have big capital projects that are growing quickly. But there's also these large legacy businesses that aren't able to grab as much of that growth. And they said, okay, well, I've been trying to grow my dividend at a 5% CAGR. That's out. And now I got a debt servicing cost that's going to double on me if this thing sticks around for 5 years. And by the way, I can only pass, and I learned this last night, this is a great tip, roughly a fifth of my interest costs increases into the pipeline system. Like you can get really stuck. And, where does that lead? That leads to asset sales and all sorts of different things. But it is going to have a huge change on that part of the cost structure. So there's kind of two components. One component is, okay, let's say tomorrow we could build more pipe out of Appalachia. What's the quick numbers on what that would cost? And TC offered this little nugget. They said, to build pipe from our Columbia system into the Gulf is a $2 toll. And so when you think about it, like, oh, wow. So $2 toll, let me think about the implications of that. So that marginal molecule, that marginal, whatever the expansion would be, 500 or B, the transport itself is $2. My F&D at home is, call it 50 cents. All my other costs kind of get me to $75 a dollar. I'm $3 before I've turned any profit at all, coming out of the best rock in arguably the world, definitely in North America. And all of a sudden I'm behind the ball on some of these other plays. Like, how did this happen to me? It's because these new lines are going to be so costly. But so then it kind of comes into like, well, who takes the leap and pays that large incremental? And, there's people who've been burned, like Rover Nexus were similar. They were kind of $1.25, $1.50. The big commitments on Rover Nexus were regrets very quickly. Those were
never want to be the guy making the big commitment. It seems like inevitably the guy making the big commitment, it's like, you just kind of, all these plays tend to go through these cyclical, because the industry's cyclical. And one thing we always joked about, because we were at Chesapeake, Aubrey wanted to like own all the firm, and for good reason. He had, typically a first mover position on acreage, but it was like, do we really need to this many billions of dollars worth of commitments? And then inevitably the price of gas would fall, and all the other guys that are just piggybacking getting an interruptible rate because there's plenty of space, and they're paying 10 cents or 5 cents, and you're paying 40 cents, and you're getting a demand charge because you didn't fill your capacity. So it's always like, who wants to take that leap? And the other thing is just like the credit side. Who are the players that have the credit worthiness to do it? And if you look at a lot of these areas now, there's more consolidation, and bigger guys and mid-sized guys are rolling up different groups. But we work a lot with private equity or smaller groups that have material positions and can, ramp up a good amount of gas. And it's like, well, should I take out firm? Should we get in on one of these projects? I'm like, you guys you're a shell company. You just, you basically sweep your equity to the equity guys. There's not really a credit. There's really no credit here. And so then it's like, that's a layered cost if you want to make that commitment. So it's somebody has to make those commitments. And then the other thing is the M&A side for midstream. So we had a midstream vehicle. We were trying to do M&A, and I don't know if it was good or bad timing. We raised a couple $100 million back in 2018 and chased a bunch of things, did one small greenfield, but then we're looking at acquisitions. And it was impossible to acquire anything because in 19 and 20, obviously things slowed way down. And then you had guys that had spent a lot of capital. Yeah. They needed this ramp up to happen. It hadn't happened yet. Or they were a legacy system where it was relatively flat, but people just still needed this multiple to be paid to get a return on their investment. And you're looking at it and just penciling it as hard as you can. And you're like, if I lever this up, maybe I can get a 15%, if I give them the multiple they
just
want.
Feels too hard.
Yeah. It's like, if I give them the multiple they want, it's like a single digit IRR. And then like I can lever it and get to like this mid double digit IRR in the teens. But it's like now, again, with the risk-free rate going up, you're a CFA, you have your CFA charter, like the calculation on how to value things, and the risk-free rate's an important part of that calculation. And so how does that change for guys that have assets and maybe want to divest, and the ability for a buyer to pay the amount that they're going to need given the different rate environment?
Yeah, the hurdles totally change. Like they need, call it double the rate. Like if you were looking for, high single digit IRRs before, I think you're mid-teens now on just risk-free alone. But
right.
The also, before we were in this, let's go, let's grow. And now there's discipline. So your growth aspect is very, very kind of boutique. There's only specific plays that grow. So if it's a legacy asset that doesn't have a big growth profile, it's going to be hard. And there's probably some lumps to take. There's going to be some, oopses in hindsight. Right. It's the part, like people look really hard at service costs. People look really hard at, okay, what's the LOE doing this quarter? But if we are in a higher interest rate environment for even a couple of years, it permanently changes some of the cost structures on this infra side, which is important. Like that's means that 225 is an unrevisitable number, because if you're paying a $2 toll, you're out of the money 50 cents earlier than you were going to be before. You're going to pull back faster. Everything changes faster. And so, we're kind of resetting the floor. And the longer we persist at kind of 4+% rates, the higher that floor resets to. If it was 225 before with the associated push, no associated push, maybe you're 275. Now maybe the right marginal cost of supply is not even 350, but 450 if we hang out here for even like 2 or 3 years. And the moves that the infrastructure guys are going to have to make over the next 36 months greatly influence that, because that's where these postings are going to get kind of settled out in the math.
Yeah. It's all good stuff. So I'm just doing a little math here to talk about this next example on my calculator. So one dark horse that I think caught a lot of guys by surprise in the E&P world, and this gets back to the margin side, is escalators. And you don't see anybody really talking about this either. But if you'd hired Ancova, our company, we always put a cap on these things. We try to, at least when we negotiate new deals, because a lot of times it's like a trade bait thing where guys are like, well, it's a CPI escalator, and let's look at the historicals. That's nothing. Like, why are we 2%. Like, it's only 2%. It's only one something percent.
Tis but a scratch.
Yeah, right. On this 20-year GMP agreement with a $1.25 fee or something to start, or a $1 fee to start. And then, escalation season comes around and guys are like, whoa, wait a second, my fee's going up how much? And you're like, yeah, you could have a CPI inflation escalator on here. And so I don't know if people are really thinking about that or talking about it. Maybe inflation comes down and it's just a 1-year blip, but it's definitely going to increase fees. If inflation's like in the 4% or it stays, like, let's say we don't get back down to 2 for a while, I mean, this could be a serious bump to these fees, and for the midstreams, maybe a little bit of relief in terms of their margins. Yeah.
And like, it's a bear point, but if you get uncertainty around that, like, okay, we've been 4 for a while, but our view of what future inflation is going to be is less certain than it was before. The one thing that this really hurts is mega projects.
Yeah.
Like if you're going to put money in the ground today and you're not going to start returning cash flow for 4 or 5 years on a highly volatile and inflationary environment, like, man, that's tough.
Yeah.
So it benefits short cycle, but things like big offshore, LNG would be part of that. I would admit that, that just gets that much more challenging.
Yeah, absolutely. That's a good one. Man, I feel like we could talk about this stuff forever. I'm just nerding out this whole pod. This is really one that's speaking my language, but we're coming up on an hour. Last thing, I guess we'll hit on, you mentioned natural gas's role in electricity generation. And, we've seen coal take a lesser role. It's also easier probably to export, and the prices have gone up too with coal. So maybe the switching isn't happening as much. But you see some chatter on Twitter showing like wind and some of these renewable projects eating into things. Just general thoughts on the domestic kind of power gen demand and natural gas and are renewables really going to make a huge dent? Is nuclear going to have a resurgence? I mean, I don't know, just any broad thoughts on that theme.
Yeah, you actually had a great episode, I think 1 or 2 ago, cost of energy, and that was awesome. That guy hit all the great points. So I'm not going to retread any of that ground. Where we observe it and where I observe it is in areas that have tried to make a big renewable push, what's happened in the background on baseload. And like, if you look at California's gas as a percent of the pie, their gas consumption in the Northern California would be kind of, 47%. 5 years ago, it's like 46% today. They haven't gone anywhere. Hydro is a part of the story there for sure. They've had a drought, so call it that there's 3 or 4 points there. But you just have to like go back to simple like parts of the day when solar is down at 6 and you need power, who are you going to rely upon? And gas is going to be there for that base load. And so like when we think about, okay, gas demand going forward, how will this ramp? Gas will enable all of these other less carbon intensive generations, but you're going to need something to help you stop from overbuilding at a 10x factor. So if you're going to try to go all wind solar, you're either going to need a massive battery load, a massive import from other jurisdictions, or you're going to have to go like way over the top on overcapacity. And that's what you've kind of seen in California is they've built too much solar. In a sense, they're trying to store as much or they export during the middle of the day, but it doesn't fill their needs in a 24-hour day. And on a seasonal basis, it definitely falls flat. And that would definitely be true in Canada. You just can't do it. So we think you have to think of the grid in kind of 2 parts, base load, interruptible, and you got to invest in both. And the conversation's only been on the renewable side, which happens to be largely interruptible. I think nuke definitely has a place to play. During my time at Castleton, there was a utility trader who followed the nuke story closely and effectively bankrupted 2 of the businesses in his coverage group. Like nuke is really expensive. There's some room to move policy-wise to make that more affordable. And I don't know if I've seen evidence of nukes being built at reasonable cost yet, but that makes sense. But I think right now you kind of need all forms, right? So we need to like charge for it on all forms. And where I think looking forward, you have to have a bit more, reasonable demand expectation is we're generally consuming energy at a pretty consistent clip. As we introduce more volatility into the grid with these interruptibles, there's going to be a kind of come to Jesus moment in each jurisdiction where they say, "Oh, we got to do a baseload investment." And I think that's kind of the theme of the next decade is this reinvestment in baseload.
Yeah, I did a meme one time that was popular, and it was like that Trojan horse meme where it had like the energy transition, but like inside the Trojan horse was like natural gas, and they were like bring in the energy transition, but secretly they were bringing in natural gas or whatever, and like that was like my simplistic way to express this phenomenon that I think is going to happen with needing the more baseload. And I think with renewables, from all the episodes I've done and people I've talked to, it's like it's easy to scale it to a point, right? Like there's a quick win aspect to the renewables where you can build out so much to a point, and then it's like, all right, this is creating some problems. And to your point, has to be baseload invested behind that to support it. Last thing, because we're hitting an hour. You got a lot of tools. You're a smart guy. You understand the markets. What do they got you doing at your current role, and what do you focus on kind of day to day when you're making the sausage for your existing role?
Yeah. So Tourmaline, Canada's biggest nat gas producer, a big player in the U.S. side. So I'm doing the capital market side. So I'm helping out on the IR side, so interfacing with our investors and helping kind of try to craft our story so it's easier to understand. Then also helping out on the deals. So we've been very acquisitive in not so much recently, but in past history, we were very acquisitive through kind of 2021 where things were quite cheap. And so helping out as a part of the broader deal team here on what makes sense to bring in, what could we pay. We've also got a sister company. It's now very much its own business, but Topaz. And so they've been long a strategic partner for us. So they're a royalty infrastructure business. So similar to what you have in the States with some key important differences. Drops on royalties and drops on infrastructure. So helping that. So it's a bit of structuring, it's a bit of deals, it's a bit of IR, but it's been great to be on a bird's eye seat here in a natural gas operator to kind of see inside out. And I think that's helped my perspective on the markets a ton. But
that's awesome.
Thanks very much for having me on. And I really enjoyed speaking with you today.
Yeah, thanks for coming on. That sounds like an awesome role. I'm envious. You get to do cool things as an entrepreneur and doing a smaller thing, but there is something to be said about being in the seat at a larger nat gas producer. You're like on the bleeding edge probably of everything that's going on. And man, I appreciate your insights on this episode. It's been a really fun one, and I think the guests will really enjoy it. But Jamie, it was great meeting you.
Yeah. No, kind of back to where you started. It's been luck and trying to choose great people to learn from. So that's what I've enjoyed. But no, great meeting you. And in the entrepreneur side, it's something I've never tried. So maybe one day way down the road. But right now, I'm having a lot of fun.
It's cool. It's a little grittier, a little scrappier, but you learn a lot too. It's just it's different. And there are days when I'm like, that was kind of cool. Cause like, when it was like a Chesapeake or one of these big companies, like you don't have to think about what to do. You got more to do than you have time to get it done. And sometimes in the entrepreneur side, there's like a level of creativity you got to like come up with, like, all right, like we got to go do this or this. And, you have to think about things. So it's just a different mindset, but it's also, I look at what you're doing now and I'm like, man, that seems really exciting. It seems fun, to be honest.
I checked their website, like the breadth you have is huge. So it's nice to have a wide toolkit too.
Yeah, absolutely. Jamie, thanks for the episode. It was a lot of fun.
Yeah. Thanks very much for having me on.